Welcome back. We came across a piece of interesting research yesterday. We talk a lot about what stocks lead the way and what stocks like NVIDIA and the Magnificent Seven have done to your 401ks and what the returns are on this show. For a while, it looked like those Mag 7 stocks that they always talk about, they were the only train to be on. But things are shifting a little bit now. You take a closer look at their year-to-date performance, reveals that not all the members of the Mag 7 are carrying their weight. Now, NVIDIA and Meta are far outpacing the rest, with NVIDIA stock up 167% this year, followed by Meta, which is up 67%. To give you an idea, the stock market's generally speaking going to tape. When it came out this morning, up around 23%-ish. So that'll give you an idea. So the other five, they're trailing that 23% return, signaling that the market's strength may not solely be relying on these big tech names anymore, right? Dividend stocks, value plays, even utilities are finding favor with investors now, indicating that the strategies beyond big tech are maybe proving to be a little bit more successful in this current climate. And my next guest, he's been talking about a much more balanced and broader approach, maybe an equal weighted approach. We thought we'd bring him on to explain. Please welcome into the show, Craig Bolanos. Craig, I read this research yesterday. It comes from another one of our contributors. He does a great job. He couldn't be on, but it maybe reminded me of you, with the gains now coming more from stuff not Magnificent Seven, kind of spreading out amongst the other classes of stocks. You've been kind of going on about this idea of equal weighted stocks in the S&P 500 rather than weighted by market cap, correct?
Well, that's right. I'm so happy you gave me credit for the equal weight. It's been a core part of the philosophy for the entire year, Scott. And again, the burden of proof for this market lies squarely with the bears. So we are still optimistic. We are still bullish, but there's a reason that people should own industrials. There's a reason people can own utilities, as you mentioned. Look at all the fund flow that went into the real estate sector in the month of September. This index or this market is broadening. Not as broad as I would like it, but we're slowly getting there.
Okay, so just for the viewers, explain to them the difference between, say, just buying the index or buying equal weighted stocks.
Well, the normal index that we talk about, like the S&P 500, the spider, that is a cap-weighted index. And what that means is the companies that have the largest value, they're effectively going to control what that index does. So whether you look at the Magnificent Seven, whether you look at what used to be the FANG stocks, you can be invested in the S&P 500, but what you're really invested in is your overweight into 7 or 8 companies.
Right.
Compare and contrast that to an equal weight index where every company in that index is worth 1/500th of the index. So a stock like Walgreens, which is having a huge pop today on the back of cutting 1,200 stores, Goldman Sachs, a whole bunch of financial names, they matter just as much as NVIDIA does, and that gets people more diversified.
And so that's a great example of how this Magnificent Seven now might be just the Magnificent Two, and how a lot of these gains are not coming from those other 5 that have kind of fallen out of favor. I mean, they're still up, but you're starting to see, like you said, other sectors really starting to perform, which I got to think, I hate to say it, but I don't need to say it, that sounds a lot more healthier to me.
It sounds healthy. We're not there yet, but you want a stock market that has a strong base, right? I mean, think about the pyramids in Egypt. They have wide bases and then they narrow at the top. We were in a place at the tail end of 23 through the first 6 months of 24 where it was kind of an inverted pyramid. All of the gains were coming from a handful of stocks. That makes it fragile. It can, topple over. When you get this broad participation in more sectors, in more companies, I think it can give people some confidence that there's not just resiliency in the economy. I think it speaks to the so-called soft landing, no landing narrative, which no one still believes, that clearly is in play.
Well, I think JP Morgan believes it's still, well, not the no landing, but maybe the soft landing. They think we've actually stuck it. Who knows? But, and I just got done in the last segment, 80% of America I still think is struggling. I know that, it's not as easy. The upper 10 or 20% that own most of the stocks, they're probably doing the best. But I do like this idea of, in your line of work, this broader based growth rather than this one or two centralized growth. That's got to make it easier for you, right? Or at least safer.
It makes it much easier. I mean, no one wants to get retired on just a handful of companies. You wouldn't bet a lifetime of savings and work on just a couple of things. I mean, the best way to stay retired is to build a globally diversified multi-asset class portfolio, and that's what a broadening market does.
Yeah, because we've seen it now over the last few years. You must admit it probably was a little harder for you if you're trying to get those returns, because all your customers do is see the Nvidias out there, all of the Magnificent Seven stocks, and they're wondering why they're not really, their portfolio is not mimicking it, right?
Yeah, everybody wants to chase the hot hand. We know that. We see it in sports. We see it in lots of different places. Momentum is a trade, and trading is very different than investing. When you're investing, price always matters. And when you have baskets of stocks trading at 35 times earnings, maybe it's justified, but what's the reality? Are those stocks really going to go from 35 times earnings to 45 times earnings?
Right.
I think that's a tall stretch. I would rather buy durable companies, quality companies, companies that are growing their dividend, led by great management team with wide moats that aren't set up for a large valuation correction, just in case it's not a trick, just in case it's a treat as we come into the spooky season.
Good for you. Got the little Halloween reference and love it. Great stuff as usual. You put it out there so I can understand, so hopefully everybody else can too. But that's always good to hear from you, Craig. Thank you very much for letting us know what's going on out there. Craig Bolanos, he's the CEO and co-founder of the Wealth Management Group in Chicago.